There is a Solution for That is sponsored by VARC Solutions. VARC Solutions helps small businesses succeed by delivering expert QuickBooks bookkeeping, consulting, quick-base development, and integrated solutions. If you own a small to medium-sized business that uses QuickBooks or QuickBase, the experts at VARC Solutions can help. In business since 1999, with people who care and the knowledge and experience to solve your toughest problems. Visit VARCsolutions.com for all your QuickBooks needs. Welcome back to another edition of There's a Solution for That, where we help small businesses succeed by discussing challenging business problems and best-in-class solutions. Welcome, everybody, to the latest episode of There's a Solution for That. We have got a great topic today, a mysterious topic a lot of people are asking about, a lot of people are curious about, and that is the topic of reasonable compensation. Well, and the good news is we have a great guest on today that's an expert in this area that will help educate us and demystify this topic. So Kevin Lacey of Mariner Consulting, tell us about you and your firm.
Hey, thanks, Brad. Great to be here. We have a small boutique accounting firm. We work with small businesses, about $500,000 up to $3 million. And a lot of those are primarily S Corp. So this topic that we're talking about today was of great interest to me. But we do bookkeeping services, payroll, cleanups, and a lot of inventory implementations.
That's fantastic. And I know on a personal level, we're kind of in the club, so to speak. We see each other at all the conferences. We're partners in many ways in terms of work that you guys do, and vice versa. So glad to have you on the show.
Yeah, thank you.
Yeah, and of course, you also are providing those CFO level services as well, which is something that I know a lot of people have a need for. So, but yeah, let's dive into it. You mentioned S Corps, right? And so let's talk about reasonable compensation. First of all, what in the world is it?
Yeah. Reasonable compensation is the amount of compensation that you record, or the payroll that the owner pays themselves when in an S Corp. So one of the most mystifying things to me was everyone, including CPAs, had a different opinion on what this number should be. But you need to calculate for the IRS what part of your income is salary and what part is really the dividend from the business.
Okay. And so I'm going to just beg the obvious question, which is, why does this even matter? Can I just pay myself whatever I want, or can I just take, draws from the company? It's like, do I have to take a salary? I'm sure that those are a lot of the questions that you get when you talk to people about it. So tell us a little bit more.
Yeah, well, from the IRS perspective, they want the payroll tax on the compensation. Like if you were paid as an employee, they want those taxes on that compensation, because the rest of the dividend or net profit from the S Corp flows through outside of payroll taxes, which is one of the main advantages of an S Corp. And I want to clearly say I don't do any tax work. This is the only area where I kind of get into this sort of thing, but reasonable comp very much is an operational issue and an ownership issue. But it's something required by the IRS, so it kind of crosses both lines.
Right, right. Okay, so even though you don't do tax like advice, right? You maybe don't do tax returns, there is a tax impact. And so I think you basically said it, and I'm going to replay what I heard you say just to make sure I get it right, and you can, check me and make sure I'm not messing it up. But so like if I was the owner of an S Corp, and I just said I'm not going to pay myself a salary at all, right? I'm just going to take distributions or dividends from the company. I'm not paying the employer payroll taxes for that. All the money that I get at the end of the day, it's taxed as income when I file my return. Whereas if I'm paying myself as an employee, I'm going to get, I'm going to get a W-2, and also those wages are going to be taxed just like a normal employee. Is that right?
Yeah, exactly. And both sides of that employer tax, when you're the S Corp, you're paying. So I've heard all sorts of theories on what people think it should be, but the solution of reasonable comp has a very narrow definition in the eyes of the IRS.
Okay, so let's put some guardrails around it, or at least try to eliminate some of the gray, on the fringes here. So, I mean, I've got to imagine, like you mentioned, everybody's got an opinion about it, and I'm sure there's like that's definitely not right versus that's definitely within the realm of correctness. So, I mean, obviously, so let's say I had you mentioned like the up to $3 million. So let's say I've got a $3 million business and I'm the owner slash CEO, and I decide to pay myself as a CEO $5,000 a year. That doesn't seem reasonable from a wage standpoint. Whereas I still might be doing 200,000 or $300,000 in distribution. So at the end of the day, I don't care. I'm getting paid,
Right.
but there's going to be a point where it sounds more and more reasonable. So how do you generally advise clients on this? So like, where do you go, or how do you sort of get approximately what the right number is?
Yeah, the company I work with is called RC Reports, and they have an extensive database of employment data down by region, by the type of job you do. And the most popular method of computing what reasonable comp is the theory of many hats. Whereas a business owner, you may be doing half of your day is marketing, half is sales, half is accounting, or not half, but like a percentage is accounting. And just you have all these different little things that you do a couple hours a week. So, in the process of determining what your reasonable comp is, it's compiling a report based on exactly what the business owner does and exactly the demographics of the payroll, or the geographics of the payroll, the type of job they're doing, the duties they're doing, and it very detailed report that kind of individually describes exactly what it is you do and exactly what is reasonable for your area and your unique set of job description. So everyone's can be different. Every single one is going to be a little bit different.
Okay, so let me see if I can kind of flesh out some of the details here. So you mentioned geography. So let's say I mean, again, XYZ business. I'm sure there are some variances depending on industry, but let's focus on geography right now. So if I was the owner of an S Corp operating out of San Francisco, California, very expensive area, Silicon Valley, New York, major metropolitans where it's really expensive to live, and obviously people that live there have to have a sufficient salary to even live there. I imagine that's different than if you were in middle of the country, in a very, in maybe more of a rural area where there's not as much competition for wages and things like that. Is that one way of thinking about it?
Well, yes. So based on, like you said, the same position in different parts of the country will be considered. Different regions will have pay scale adjustments.
Okay, got it. And then you mentioned different hats, and so obviously there's going to be a lot of variety here. So if I was I think of like some of the clients that you have, and some of the clients that we have. You're let's say you're a construction company, and you build roofs. Okay,
Yeah.
if a lot of my time is out knocking on doors trying to sell roofing, I should be getting paid as a salesperson when I'm wearing that hat, right? Versus if I'm building a massive empire and I've got, you know, uh, 20 roofing trucks, 10 different areas, I've got crews that are going out, and I'm spending more of my time truly as a CEO managing the entire, vision and long-term strategy of the business. I'm going to get paid differently for that. So is that kind of also what you're suggesting in terms of the hat wearing?
Yeah. Because when you're in a small business, you have many jobs that are part-time, and it kind of compiles those together to give a weighting of this is how many hours I do this is how many hours I do this function. And it kind of averages out what your effective rate would be for all of those positions together. And it's very market based, but then when you put in the different hats, it kind of can change that number wildly.
Yeah, this is so fascinating. Because again, I imagine people that aren't asking folks like you for like an official, report or some, evaluation, they're probably just making it up, I'm guessing.
Well,
Is that pretty much what you
yeah,
see most of the time?
yeah, and I have people that S corps that come to me that other people are preparing their taxes and they're not taking any salary whatsoever, and the tax preparer is not even mentioning that to them, and it's um, and there's all sorts of things like percentage of income or guesstimations or amount of profit or profit splits. And there are just all kinds of theories out there on what people should do. And when I started my S Corp, I heard the same theories from accountants. And this is the really only the real comprehensive way of determining and really supporting. And that's what the basis of the whole thing is that you can support a number and you don't want the IRS to come back and make you support the number after you already wrote down the deduction. You have to have the report prepared and the homework done before it gets challenged.
So for something like this, I mean, is there even a concept of like a certified reasonable compensation report, or is it still more just like, you know, hey, you do the evaluation, you do the discovery, you do the evaluation, you run the report and say, here's either a number or maybe a range. Is that generally how it works?
Yeah, well, there's no concept that I've ever heard of a certified, but the point is it's a managed kind of when you look at the company, it's a management assertion.
Okay.
So they're putting forth, this is what we do, and then you're coming along with the database of so many different, such a large collection of data that supports the number figure on what you're doing. So it's very hard to get something certified. Someone would have to follow you around each day and say, okay, for 2 hours a week you do marketing, for 4 hours you check on job sites. It just there's too much variability. But the
Yeah.
important part is that you have done preparation to support the assertion you're putting on the tax return.
Got it, got it. And I'm wondering this as well. So like, another. I mean, again, I don't do these reports like you do, so I'm just kind of speculating. But I would imagine another way of getting close to this is if you said, hey, I just want to be an owner and I've got to go hire a CEO to run this business. How much is it going to cost in the open market to go fill that position? And for some companies, yeah, that could be $100,000. It could be 150. It could be 300,000. It really is, I imagine, going to be pretty wide. But for any position that you might go do a job placement for or hire a recruiting firm to go source, there's going to be some market data that would support, you know, paying this versus that, right?
Yeah. And the one thing to keep in mind too is the IRS is going to have their own data when they look at your reports and they'll determine what you do each day and they'll
Okay.
determine the rate on it. And if you don't have something to put forth beforehand, they make the assertions that you have to defend instead of you making the assertions that they have to defend.
Yeah, and I've got to imagine it's probably better to go in with your own assertions first
Yeah.
versus
And
trying to defend what somebody else thinks.
yeah, and they have a very high defense rate. Like I think I don't want to speak for them or make any claims, but I believe what I've heard is they've never had one of their reports overturned from an assertion point of view
Interesting.
of what the company says they should be paying as reasonable comp.
Right. So pretty much it's like they just say, yeah, this is what you should be paying, and there it is,
Yeah.
unless you're doing it reasonably already.
Yeah, and there's a warning here where once you have like if this is one of your clients and you did reasonable comp for them and they said you should be paying yourself $100,000 a year and they don't want to, it's a very dangerous position you're in to even retain them as a client, in my opinion,
Mm, mm.
because you've just supported that they're making that all the data says what they should be making versus what they are reporting on their tax return. To me, that again, I don't do tax, but to me that sounds very precarious that you have support that says one thing, but you're doing another. So usually as soon as we do these reports, we put the owner on payroll if they're not on payroll already, or we adjust the rate that they're paying themselves in the payroll system.
Yeah. Well, I think we all have clients that counter to our suggestion, don't take our advice, right? It's like, hey, here's what we see, here's what we typically recommend. But clients don't always follow instructions, and they've got their own minds, I guess, to make those types of calls. So,
Yeah,
but
exactly.
but if they're reaching out to somebody like you to get expert advice, hopefully they'll take your advice, and hopefully they'll at least go, okay, well, maybe that's maybe that's not what I was thinking, but I'll go towards your direction if it's higher. So does is there any distinguishing or any difference, if you will, between an owner's reasonable compensation, or if you've got directors within your organization, or by like senior leaders, who's ultimately uh, when you on this topic of reasonable compensation, who falls within the boundaries of needing to be concerned about this?
Yeah, well, there's three places that you can use a reasonable comp report. The one is the S Corp and the owner's payment. That's the big one. The secondly, if you have directors in a company where they're just paid for what they do, you can develop a reasonable comp for what they should be being paid. There's not much of a challenge that I've seen or a real topic around this of what directors are paid because they're third parties. They could be closely related parties, but the the issue with S corps is it's almost like self-dealing. Like you're both sides of the transaction, so you get to decide how much you get paid, and then that flows through to your tax return. But if you're talking about a director, hopefully you have kind of an arm's length transaction where you're bringing on a director, you're paying them enough to do the job you want, and you're giving them enough money so they'll do it. So there's more of a fair exchange there of service for money when you're talking about directors. But a lot of times, directors will have compensation agreements that, especially in public companies, should very often be backed up by something very concrete. This is what we're paying you, this is what you're doing. And then the third piece would be if you had employees that you wanted to figure out how much you should be paying them if you're hiring somebody, and that's a more fair party transaction. But this data can give you an idea of, based on what this person is doing, they can determine what salary they should offer.
Okay, so basically, even if so you could use, so I'm not saying it's required, but you can use that same type of data and the research that's behind it to figure out, like, what should I pay certain people that have certain roles within my organization. That's another way of using that same type of data.
Right, because all it's doing is taking the different parts of the job description and amalgamating them into one position and weighting them based on those specific areas to determine what a fair value compensation would be.
Got it. Got it. So does this, so like at the very beginning, you mentioned S corps, and so we've been sort of talking within the framework of an S corp. And again, we're not giving tax advice here, but I'm just kind of curious, like, just summary. Why is this a topic of S corps, but maybe not a topic of C corps or limited liability partnerships or some other type of legal structure? Do you have any kind of sense for that?
Yeah, well, an LLC can be either disregarded by the IRS if it's a single member, or which means you file on a Schedule C, or they can elect to be taxed as an S corp or a partnership. So obviously, if you choose the S corp route, then you're right back in this conversation. Um, if you When we talk about C corps, the corporations are charged have specific tax rates, which are um, circumvented, I guess, maybe the best word. When you're an S corp, it flows through to your personal return from the K1. It
Okay.
it's not subjected to corporate tax rates. So
Okay.
the reason we talk about why reasonable comp is important for an S corp is because you have the ability to avoid a lot of taxes. And the IRS says, well, first, before you give yourself full payment, you have to determine what compensation you would get if you were an employee.
Got it. Got it. So like in a C corp, and again, this is just talking about what I think I know.
Yeah.
So
You and me together.
right. So a C corp, the business is taxed as well as the individual is taxed based on what they've earned. Whereas in an S corp, all the money of the income, all the income of the business could ultimately flow tax free to the person, and then it's up to them on their personal return to get taxed on that money. So it's not taxed twice. Got it. Okay.
Exactly.
That makes sense. So it sounds like for those that are listening to this show today, pay it special attention if you are an S corp and haven't really addressed this specific topic of how much you're getting paid and reasonable compensation. So let me maybe kind of, as we wrap up this topic, I'm curious, especially from what you've seen, what are the ramifications of not focusing on this? What are the consequences if I get this wrong or just don't get it right enough?
Right. Well, like anything, the IRS can come in and make their evaluation, and then you're at a grave disadvantage if they're wrong. Um, your appeal or take them to court are your alternatives. But once you don't have proper documentation for what you're doing, they're going to come in and they're going to examine what you do have and determine what they think it should have been. And then they can reassess amounts of money that you paid yourself and charge you taxes based on that, and penalties and interest, and just recharacterize income.
So the normal stick that the IRS has, which is we can tax you, we can penalize you, and we can charge you interest on everything that you haven't sent that you should have sent, basically, right?
Yeah.
Okay, got it. All right. Well, Kevin, as we conclude this episode, any other sort of last tips or suggestions? Like, especially again, I know you have these conversations with S corp owners all the time. Um, when should somebody reach out to somebody like you? Is it ever too late? Like, just kind of what's your best tip or guidance for some of the owners that are listening in right now?
Yeah, one of my favorite expressions is the second best time to plant an oak tree is today. The best time was 50 years ago. And if you didn't do that, you're at this point right now where you should start doing something. And the IRS says you should have one of these evaluations done every year. And I think so many things that don't have a clear and present risk right in your face, like you're getting a letter, or you have reason to believe that things are being examined. People want to push it off. They think, well, it hasn't happened so far, so I'm good. And there's a large risk in getting this, or large potential risk in the outcome of the penalties and the interest and things being recharacterized.
Okay. Well, so if somebody wants to learn more, and especially if they want to get a reasonable competition report and really suggestion from you, how do they get a hold of you?
Yeah, you can go to our website, which is Mariner, Mariner, grp.net.
So
And we would
Mariner,
love to talk to you.
Mariner Group GRP. So MARINERGRP.com. So yeah,
.net.
go to that website. Yeah, go.
.net.
.net. Sorry, thank you. .net. And so if you didn't get that, you can always reach out to us and we can put you in touch with Kevin. I know he's a great guy and would love to provide an introduction as well. So Kevin, thanks again for coming on the show and just sharing what you
Yeah.
know.
Thank you very much, Brad.
All right, fantastic. And for everybody else that's listening, again, I hope this was helpful. If you haven't gotten a reasonable compensation report in the last year, which is highly likely, let's do something about it. Let's be more proactive about it and make sure that we're not just doing what's right, but also making sure that we're protecting ourselves from the downside of not doing it, and getting yourself in a better position, like Kevin was saying, in case there ever is an audit, and you don't want to look bad sort of in hindsight. So again, hopefully this is a great episode for you, and we'll talk to you again on the next show. There is a Solution for That is produced by VARC Solutions. This episode was produced by Ashley White and Aaron Riley. You can subscribe to this podcast on Apple Podcasts or Spotify. Watch the video version on youtube.com/there's a solution for that. or visit thearcsolutions.com/podcast, where you'll find our entire podcast archive, as well as show notes, links to solution providers, and complete transcripts of every episode. If you love the podcast, please leave a review with your comments.